Thanks for tuning in to the Motor Research channel. The content in today's video is highly relevant to current market conditions, but it is last month's video. If you like what you see, you can head over to our website to get a 1-month trial, which will give you access to all of our current and prior research and videos. See the link in the description below. Be sure to like this video and to subscribe to our channel to be notified when we post more valuable content. Enjoy the video. Welcome to the June 2024 monthly motor checkup. My name is Dave Lundgren, and I'm the Chief Market Strategist here at Motor Capital Management and Research. The topic this month is I really want to drill down on what we all know to be the very narrow leadership within the bull market, and most importantly, how that thin leadership is now beginning to thin out itself as well. And so my concern and my thinking is that this bull market, unless we can get some sort of a refresh of momentum where we get the traditional breadth thrust that we've been lacking for a couple of years now, until we get something like that, as this breadth continues to deteriorate, I just begin to become more alert to the possibility that this has the hallmarks of being something that's prepping for a more serious bear market down the road. That is not the case right now. I'm still bullish, still view the world as being okay. You know, I talk about sideways to up is the most likely scenario, and I still feel that way. But I just think as these things begin to pile up and mount, we need to pay attention. Before we hop in, I just want to give you a moment to review the important disclosures. Okay. So the bull is getting tired. So as we all know, that this bull market has been very narrow, frankly, since the banking crisis in 2023. Prior to that, off the October 22 bottom into the banking crisis, we actually had a very robust bull market taking shape, with most stocks leading. In fact, the tech stocks were underperforming. A lot of the Mag 7, what we now call Mag 7 today, were underperforming, and we had a very robust scenario at the time, which all, of course, melted away with the banking crisis. And it's been very, very thin since then. So what we can see, obviously, at least from an index perspective, this is not bearish. It is what it is. And that is just, it's descriptive. It's describing what we all know to be a very narrow bull market. Bull market nonetheless, it's just narrow. So having said that, the tactical concerns that I've been highlighting for a couple months now, they continue to worsen, and I've got some pretty interesting charts to show what I mean by that. And most importantly, however, the breadth within that already narrow leadership is really beginning to thin out as well. So this is something we need to be not necessarily act on today, certainly in the aggregate portfolio level. I mean, there's obviously things to do at the individual stock level each day, depending on momentum and trend breakdowns and things like that. But in the aggregate, there's no necessarily bearish actions to take today. In fact, still bullish, but this is getting thin enough that we really want to start to pay close attention to this in the weeks and months ahead. So rather than getting all enthusiastic about the few names that are breaking out and pushing the indexes higher, what I would prefer to do is to focus on stocks that have been leadership along with these Mag 7 names, but many of which have actually paused over the past month or two and have actually completely reset their momentum clock and are now sitting at support and providing great setups to monitor for potential engagement in the weeks ahead. And again, these types of names are what we focus on in the weekly motor chart pack. So I'd be sure to keep an eye on that each Monday morning. When I started last month's video, I kind of started off with this slide, and although the concept that you see in this slide is something that I speak to in every video, I just took some time last month to just kind of lay out the sequence of questioning and the importance of keeping the sequence of questions this way. And ultimately, the idea is that these 3 questions need to be answered before you even know what to do in a portfolio, at least how I think about the world philosophically. And so we need to first address whether or not the regime is up, down, or sideways, or some combination. In other words, is it bullish or bearish? And of course, answering that question will tell you, will influence how you answer the next question. Tactical. Should we be tactical at all? And if so, when and where should we be tactical? and then stock selection. In this environment, given how we've answered the last two questions, what, if anything, should we be long? And of course, or short. And of course, that can take many flavors. That you could be addressing questions like what sectors, what market cap, global versus US, any themes, things like that. So it's more when you look at the what's on the watch list that I'll talk about in a moment, what's bubbling up on that watch list in terms of things that we should be looking at. And again, obviously, depending on how you answer those first two questions, you'll find that different things bubble up to the top of that watch list. So this is how it looked. The market looked through our lens at the timing of the last monthly motor checkup, and this is what it looks like now. So just to give you a quick opportunity to see this unfold again, if you just keep an eye on these buckets over here, you'll see they drop. So what happened since the last monthly motor checkup is we have now seen the majority of charts on the weekly time frame are now in a downtrend. So only 39% are in an uptrend. And within this column, if you add all of this up, it adds up to 100. In each column, the biggest bucket of all of them is colored in blue. So the biggest bucket on the weekly time frame chart is a clear downtrend. So what I mean by a clear downtrend, when I say that, I'm talking about a chart that is basically doing this, lower lows and lower highs. Anything that's in a down base is just kind of back and forth in a base in the context of a downtrend. So the point here, though, is that the largest trend bucket right now in the weekly time frame is actually a clear downtrend. Now, this pressure in the weekly chart has been sufficient enough to pull the monthly time frame down as well. So we still have a majority of charts in an uptrend at 58%. So if you add up these three columns, these three rows within this column, you'll get 58%. So the majority of monthly charts are still in an uptrend. And it's just that this weakness that we've seen in the short term has pulled the largest bucket down to an up base, which as I just indicated, is a stock that's in an uptrend, but it's just, it's trending, but it's just kind of gone into a base. And if it's an up base, it means it's in the top half of the base. If it's in a down base, it's in the bottom half of the base. And so this is the biggest bucket here, up base negative. So we have on the monthly chart, most charts look like this. So not bearish, and I'll stress that again and again and again, it's not bearish. It's just that it's beginning to surprisingly thin out. I mean, think about what's happened since the last monthly motor video checkup. The indices have broken out to new highs, and I'll give you some more granularity on this in a moment, but it's interesting to note that while all these indices are breaking out to new highs, we actually have fewer stocks trending along with the market. So all of this combines to leave the risk gauge in the short term down ticking to 6. The good news is that the long-term and medium-term risk gauges are still just hovering just below risk on. So again, there's no reason to abandon the bullish view. It's just, I just feel like we're still in that environment where we want to be very mindful of the tactical aspect of where we are. Are we overbought or oversold? And then it's growing increasingly more important that we also begin to monitor the degree to which the leadership itself, which is narrow to begin with, itself is also beginning to get more and more narrow as well. So things to watch as we go forward. These charts here show you the entire condition of the entire motor universe, which is about 2,800 stocks. What I thought would be interesting this month is to take a look at the same exact models, but broken down by market cap quintile. So we all know that large caps are leading and small caps are lagging. And the lower you go down on the market cap ladder, the worse it gets. So here's something that I thought was interesting. When you think about what the large caps have done in the past month, right? The S&P is up about 5% or so or 3% since the last motor video. The NASDAQ is up about, the Qs are up about 5% since the last motor video. And while that's the case, it's worth pointing out that the biggest bucket now in the largest quintile, this is the market cap quintile number 1, the largest quintile, the largest bucket now is this up base. And the largest and I want to stress again, in the mega caps, and not the mega caps, but in the large caps, the largest bucket in the short-term time frame is downtrend. This is with the S&P being up 3% over the past month or so, and the Qs being up 5.5%. So there's clearly a disconnect going on here between what the average stock is doing and what the index, the cap-weighted or cap-driven indexes are doing. Now, comparing this to the smallest quintile, which you see here, this is the fifth quintile. The largest bucket across all of these time frames within that lowest quintile is clear downtrend, and with the exception of this one, which is obviously just barely making it into 50, the majority of charts in these very important fundamentally driven charts, these long-term quarterly chart and monthly chart, the majority of them are in downtrends, and the percentage of stocks experiencing positive momentum is anywhere from the slight majority to the vast majority of stocks experiencing negative momentum. So we can clearly see that shouldn't be a surprise. We can clearly see that the smaller cap quintile is struggling more so than the mega cap or the large cap quintile. But it is interesting to note that despite the strength of the S&P and whatnot over the past quarter, over the past month, the Qs and the SPY, this has gotten worse. And so again, this is just at this point in time, it's not something where we want to necessarily be bearish, because if you go back to the screen, we can see that the risk gauges are hovering just below risk on in the aggregate on these 2,800 stocks. So it's not a bearish scenario. It's just, we know what robust bull markets look like, and this ain't it. When we're in a bull market, all of these buckets are blue up here, meaning that the majority of what's working, what majority of stocks across the various quintiles are trending. It's just various rates of change that give them leadership versus not leadership. So you can clearly see, just looking at this, that this is not only not a robust bull market, but the largest quintile itself is beginning to deteriorate as well. So I thought it would be I took a look at technology last month, and I'm going to do it again this month because it's obviously a very important sector. As I've said before, it surprises most people to know that it's not the #1 sector in terms of perspective of the lens of how we look at things from the bottom up. Equally weighted at the sector level, we still have industrials, financials, and materials are ahead of technology. So technology is still in there. It's still a leader, has been for a while, but it's not #1. Before I say anything about the breadth of the market, I mean, of the sector, you have to look at this first, right? So as long as this is true, you at least can't be bearish on the sector ETF. Now, at the individual stock level, once you drill down beneath the surface, that is an entirely different question. But even there, I don't think that necessarily matters yet until we can identify a bearish trend at the sector level, and you can clearly see that's not the case. So what I'm again putting out here are things that are very important to watch going forward, because if they do continue to deteriorate as they have been over the past couple months, we could see ultimately this XLK break its own trend as well, which will obviously change our first question, which is, what regime are we in? That'll change from sideways to up to sideways to down, which will change how we answer all those other questions and ultimately what we end up positioning in. So here's what's different about this breakout. So when you look at the breakout that happened after the fourth quarter correction, or the second and third quarter, I guess, correction of 2023, when you broke out of that correction, you had a very strong breadth thrust. So this is showing you the percentage of stocks in the XLK that are above their 20 and 50-day moving average. So we get a very strong, robust reading, which you can see in these other periods in the prior part of the year were also conducive of higher prices, sustained higher prices, because there was a lot of strong breadth beneath. Now, when we look at this base breakout that just happened, we don't see nearly as strong of breadth as we saw in the last breakout and in other breakouts as well. In fact, if you measure the strongest point of breadth during the last breakout to where we are now, it's actually in a downtrend. So this is again just showing us that the breadth of even one of the strongest sectors is just continuing to thin out more and more, and just getting less supportive of sustained higher prices. So when we do look at this through the lens of our own modeling process, you can't ignore the fact that we see what we see here in the index level. I mean, it's pretty robust, very strong, powerful breakout. We know that it's not strong breadth, at least as measured from participation with moving average measurements, but we also can see that the sector has taken on structural water as well. We have both of these timeframes are showing very weak price structure. So they're both in the downtrend is the largest bucket in the tech sector on the monthly chart, on the weekly chart. So yes, the quarterly chart, which by far is the most important, it is still 58% are in an uptrend. In 37% of the quarterly charts are in a clear uptrend. So that's once again is a trend that looks like this. We see most charts within the tech sector look like that, which is good. But it is kind of something we're going to need to follow going forward, because this apparently robust, at least from a momentum perspective, move out of this base, which gives the appearance of being a very healthy market, is actually quite different when you dig beneath the surface and look at the actual stocks that are in this index, and you find that there's quite a few more stocks in a downtrend. Okay, here's just to bring this all home, I guess, in terms of how bad it actually has been since the last monthly motor checkup. So since the last checkup, which was May 24th, the NASDAQ is up 5% and the SPY is up 3.3%. So again, remember, these are cap weighted indices, heavily weighted by the Mag 7 company. So what they do essentially is what happens to the indexes as well. But look at this, the average rate of change of the stocks within the various sectors. Every one of them is down since the last motor checkup. When that's measured on average. When you measure on the median, it's all but one is down. So, I just say it again, we know what bull markets look like. This is not what a traditional robust bull market looks like, where you can just kind of like not necessarily not pay attention to risk. You always have to pay attention to risk, but the risk of a sustained move lower is just not the biggest risk on the table in that moment. In robust bull markets, your biggest risk is that you don't own the leadership. And where this is clearly not a robust bull market, needing to own leadership is always the case. And I actually have some interesting charts on that in a moment. But this is getting closer and closer to the environment potentially where we need to be very mindful that we're changing regimes from sideways to up to sideways to down. Again, want to stress, we're not there yet. I'm still fully invested, still own leadership, but we need to pay attention to this. I think it's always better that if you have a thesis, you're not serving yourself very well by continuing to find supportive evidence of the thesis you already hold. Your time is far better spent looking for those data points that might ultimately change your thesis. And so that's what I'm doing here. I'm just trying to point out those things that are, they're clearly they're not constructive. They're not bad enough yet to change the thesis, but these are things, this is how, a thesis goes from bullish to bearish, one data point at a time. And as I'm showing you for now 2 months, these data points they're just accumulating, and we need to be mindful of it. The third question that we always have to ask, we have, what's the regime? Should we be tactical or not? And then lastly, what should we own? And there's a lot of ways to answer that question, but the way that I answer the question, I do this through the MOTR watch list, and I provided some information on this. I think it was in the last video, but in essence, to be on this watch list of 2,800 stocks in the universe, how do I get it down to a watch list that I really want to consider buying? That's the stocks need to have, number one, they have to have long and medium term positive price trends. So these are the quarterly and monthly charts. They need to have leadership momentum scores. They need to have leadership relative performance trends, and probably more of a contrarian take than most people would suspect. The back testing I've done, at least when you do these combinations, is that you're better off with higher volatility, higher beta stocks that have the other attributes mentioned above. And when you bring all four of these things together, this is how you get the stocks that go into this MOTR watch list model portfolio. So it's only 50 stocks back to 2001, and it's the blue line. The orange line is the S&P, and the gray line is the relative performance between the two. And so when you're looking at the weekly motor report that I send out, each one of those motor reports is the weekly motor chart pack. This is where they come from. They come from stocks that make this watch list, and then out of this watch list, we take another spin on it to try to narrow it down to a bit more of a focused list of I guess I don't want to say superior, but better than average fundamentals, and that's what gets you into this motor watch list portfolio, which is again is 50 stocks. All of that is to just highlight and just remind you that this is the process that we go through when we are monitoring the market for what we should be including in our weekly motor chart pack, what we should be including in our portfolios. All of this is kind of leads us to this point, which is to say, one of the benefits of having this motor watch list produced is we now have X number of stocks of a 2,800 universe. You can see here it's 2757 of a near 2,800 stock universe. We now have a bunch of those stocks that are now on the watch list. We can then ask questions like, okay, what percentage of we can see here that industrials are the number one sector, financials are the number two, materials, then there's tech, as I told you earlier, all the way down to communications and media at 11. So we can, with this watch list, we can now say of the industrial stocks, what percentage of these 347 stocks are on the watch list? And it's nearly 32%. So almost a third of the industrial sector is on this watch list. That tells you a lot about how robust and strong that leadership is. And then you can say, okay, of those roughly 110 or 120 stocks, which is 33 or 32 or so percent of this, or what percentage of the entire watch list is that number? And it's 18%. So 18% of the entire watch list comes from the industrial space. And that's a number that you can then compare to this number right here. This is the percentage of the entire motor universe that's in the industrial sector. So we can see here that the industrial sector is 13% of the entire universe, but it's 18% of the watch list. So the watch list is overweight industrials. And then as you move down this list, you can see that the leadership is larger in the watch list than it is in the entire index itself. And then as you get into the laggards of the ranking, you can see that these numbers are smaller than their representations in the benchmark. And this is a key component to how we assess market activity and where we want to be focusing our idea generation for our clients and, of course, the holdings in our portfolios. As I had mentioned earlier, one of the things I'm trying to stress is, first and foremost, there are still plenty of good charts to own. As I said, the majority of charts in the quarterly time frame are still in clear uptrends, and so there's no concerns for, ultimately there's always going to be 5 or 7 or so percent pullbacks in the market. What I'm always trying to assess is what's the risk that a 5% pullback will drive the market to go lower and go down 20%. That's the difference between bull and bear markets. So when you get a 5% pullback in a bull market, that weakness incites buying at support and the market goes on to new highs. When you get a 5% pullback that looks exactly like any other pullback in a bull market, but when you get a 5% pullback in a bear market, that pullback incites more selling, causing a 20% decline. So that's why that first question, what kind of a regime are we in, is always the most important, because once you know, at least statistically and systematically, the way I've been describing it to you so far, once you know that you're in an environment where the worst case scenario is sideways to up, when you get these leadership names that are oversold in uptrends, there's no guarantees or any promises of anything. But if I'm going to wash, rinse, repeat something for the rest of my career, it's going to be buying these oversold conditions at trend support. And so, as I mentioned earlier, although the S&P and the NASDAQ are up since the last motor checkup video, most stocks are actually down. So what I'm focusing my attention on today, both in terms of the portfolio as well as idea generation for my clients in these weekly motor chart packs, is finding these leadership names, strong relative performance, that have pulled back to support and offer a good setup to monitor for potential resumption of an uptrend. And because so many stocks have actually pulled back in the past month, despite what the S&P says, you actually find a lot of these setups. So this is just one of them. And again, you'll see charts like this, and I think Marriott's has been posted recently as well. It's had a nice little bounce off of support, a step or two ahead of Trex, the last one I just showed you. But this is the kind of setup I'm looking for. It almost makes me want to talk next about the elephant in the room, which I'm just going to go ahead and do here, which is NVIDIA. In light of what I just explained to you, what I'm trying to purchase and highlight in the research as well as buying the fund, is my idea was to buy NVIDIA if it gave us this setup again. It gave us that setup back in here. And the last time I bought it, I bought this breakout and sold it on this failure at 1,000. It was at 1,000 at the time. They've done a 10-to-1 split since then, with the idea that the next opportunity would be to buy it on a check back to the 200-day average. And in this particular case, because the stock is so expensive, this is how I deal with leadership stocks that are egregiously expensive. If I get the proper setup, I will definitely take it, but I need the proper setup. Otherwise, if I never own this stock again, I'll be fine with that. And that's an important statement, and I'll show you why I feel that that's okay to feel that way. But the setup I was looking for was this, which would give us the opportunity to reset another position there. We never got it. That's relevant to me because I no longer own it, but a lot of my clients still do own it. So the question then becomes, what do you do with your holdings if you still own it? And the stock is now, very stretched above its 200-day moving average. And it's your goal to hold this stock until it breaks its trend. Well, that's a novel or admirable goal, and I actually, as a trend follower, I support you entirely. For my reasons, as indicated, where it's 40 times sales, it's just not. I'd rather own something that has a similar setup that has the potential to benefit from valuation expansion, whereas valuation contraction is going to be a headwind for this stock for a while. And if I never own it again, that'll be fine, and I'll show you why I say that in a moment. But if you still own it, here are the levels that I think you need to be paying attention to in the coming weeks and months. So these smaller boxes are monthly boxes, so these will change every month. The bigger box is a quarterly box, and that'll change every quarter. We are now in the middle of June, so in a couple of weeks, these boxes are all going to shift up. And of course, I'll keep you posted on where these levels are for NVIDIA at the time. But as it stands right now, this is where the levels are. And this may look like that's too far away for me to be able to manage this position. Well, if you really want to capture these big trends like this, then what we know about trend following, long-term trend following, is if you are unable to withstand pullbacks like this, and ultimately had it actually happened, this past pullback down into the 60 area, if you're unable to withstand that, then you're not going to be able to capture these mega long-term trends. So this may look like a lot of downside risk in the stock, and I'm not saying it's not, but it's what's necessary if you actually want to capture these big, massive long-term trends. And just to point, or maybe drive that point home, this is where the levels were on the last correction. And if you were trying to, navigate these shorter term corrections and get out here because it broke support, because you didn't want to ride it all the way down here, that's fine. Just be mindful of the idea that you then have to reposition again and don't miss it the second time, et cetera, et cetera, et cetera. So if you are trying to capture the full duration of this trend, you have to let it breathe. And these are the levels, at least as far as I'm concerned, that you need to tolerate and be willing to withstand should the stock decide to pull back. And as you can see here on the candlestick from today, we had a bearish engulfing with pretty heavy volume while the stock is very extended above the 200-day. So this would not shock me at all if we found ourselves down here, and maybe that will give me a tactical setup where I can get long again. But just be mindful that this is the magnitude of room you need to give this stock to let it breathe if you really want to capture this long-term trend. Okay, so last point before I move on, I thought this was interesting just to highlight just when I mentioned earlier how expensive the stock was. This is a chart that compares the market cap of NVIDIA to the total market cap in the individual market caps of these European countries, entire countries, the UK, Germany, and France. So the NVIDIA is now larger than those 4 countries individually. add up all the market cap in each of those countries, and NVIDIA is bigger than them. For this reason, I'm not interested in owning a stock like this without having tactical expectations around it. And I just trade tactically different than I trade or invest for long-term trends. The way I described the need to give room to the long-term trend, that's how I invest in long-term trends. I just don't view NVIDIA as being a candidate for a long-term trend because it's so large that it has this massive valuation headwind that it now has to work through. And I'd rather own stocks that don't have that. As I'm showing you here, it's now larger than 3 European countries. So it's a big boy. Moving on. This is the last point I want to make about, I said earlier, like maybe NVIDIA never gives me an opportunity to own it again. And I'm not worried about that. I don't frankly care about that. And it's an awfully brash statement to make. So let me show you why I feel that way. And this is an important takeaway about what it actually takes to be a successful momentum investor. And as it states here, momentum is not about owning all of the best performers. That's not the objective of a momentum investor. This performance line that I showed you earlier, I'm just repeating it here just to bring it up to the slide so you can see it once again before I show you the next slide. But this is what it looks like when you do own all of the best performers, or you try to capture as many of the best performers. So in this line, you see Amazon is in here, Facebook or Meta, Google, Tesla. They've all been owned at various times throughout the course of this back test because they're obviously leadership stocks. So now I have the benefit of hindsight of knowing that through the course of time, this momentum model, which uses momentum, trend, price, relative trend, and volatility, as I described earlier, uses those 4 attributes plus some fundamental inputs as well to identify what should be the best stocks with the best shot at outperforming the benchmark. And now looking at this back test, I can look back over the holdings and see that over time, this back test has owned the Mag 7. So here's an interesting question. What if I rerun the back test and every time one of those stocks tries to get into the portfolio, I don't let it, and I instead buy the next stock? So I don't buy NVIDIA, I buy the next one down. And then if Facebook is trying to get in, I don't buy that, I buy the next best one. What happens to the back test if I do that? Well, this is the chart here. Still market beating. The big drop here you see in the relative performance was during during the whole bubble effectively that happened in 2021 after the COVID crisis and whatnot. But the model portfolio has recovered very smartly, outperforming the S&P 500 since basically the October, November, December period of the bear market from 2022 is when it started to bottom, and now it's been holding its own at least relative to the S&P 500. And I want to make this statement that as a reminder that this portfolio in no time during this leg up that you see here in this performance run here has it owned any of the Mag 7 stocks. So the takeaway here is that momentum investing is robust, and the goal is not to it's not that if you don't own the ones that are the best of the best, you're not going to do well as a momentum investor. That's not the point at all. What you're really trying to focus on as a momentum investor is just making sure that you own some of the best performers and avoid all of the worst performers, and just wash, rinse, repeat that. So here's an example of a very robust back test where when the Mag 7 tried to get into the portfolio, it wouldn't let them in, and it instead bought the next best name. And that strategy still outperforms the market. So for this reason, this is why I gain comfort in knowing that the names that I do own, or the names that I'm recommending in the weekly motor chart packs and other discussions with clients, it's not that there's no short-term risk in not owning NVIDIA, which is obviously a very large, at times rapidly growing company. When you step back and look at the grand scheme of things, trying to just make sure you own some of the best performers. It doesn't have to be the best performers, while at the same time avoiding the worst performers. That's really how you succeed over the long term as a momentum investor. Hopefully that was helpful. And for those of you who don't own these Mag 7 names because they're too large, too expensive, whatever your reasoning is, perhaps the same reasons as I have, this is the reasoning behind why I'm perfectly comfortable not owning those names. Okay, so in summary, The leadership, as I said, has been very narrow, and it continues to get narrower, not just within the market, but within the leadership itself. And this is not necessarily bearish at this point, but it's absolutely something that we're going to want to continue to follow, because every bear market that's ever happened, this is kind of how they begin. And I want to stress that this has happened before in history as well, where bear markets didn't follow. So this is kind of like we're walking a fine line here. We want to stay fully invested. We want to just be more mindful of overbought and oversold conditions, and we want to be more active, and we want to be buying leadership names that have pulled back to support when they're oversold. And when a leadership name is extended and overbought, that's a good time, as I've been saying for a couple months now, that's a good time to take some off the table, write some calls, and certainly, move on names in your portfolio that just haven't been keeping up as a leadership name. If they break down in trend and relative performance in environments like this, you should listen to that and heed that message and move a stock like that on and try to replace it with something that's better. With many of the leadership stocks actually not doing so well over the past month and a half, what we find, as I showed you in a couple of examples, is that they now offer great setups for an opportunity to take positions in these leadership names relatively close to support. And none of this is to say that they're guaranteed to go up. There's never a guarantee, but what this offers is the opportunity to engage in these leadership trends at points within the trend where you don't have to stick around very long before you know you're wrong. And I'd rather be buying something like that than NVIDIA that's multiples of ATR of its own average true range of volatility above the 200-day moving average. I'd rather be buying close to the 200-day average where I know I'm wrong a lot quicker, as opposed to what I showed you, how far down you have to wait to know you're wrong on NVIDIA. And in either case, you're buying leadership. And again, it's not about owning NVIDIA, it's about owning leadership. And there's just better setups within the leadership today. Just to drive that point home one more time, that momentum is a robust factor, and success does not come only to those who own the very best performers. It comes to those who own some of them while avoiding the worst. So hopefully that's a good reminder. Okay, that's what I've got for you this month. Thank you so much for tuning in once again. And as always, if I can help with anything, here's my email, and feel free to reach out to me at any time. Thanks so much.